Hey, welcome to this ultimate guide to investing for beginners. Investing can seem overwhelming and scary, especially when you have worked hard to save your money. But don't worry, we'll break it down for you in this video. So you want to get started with putting your money to work. You might have some money saved up, but it's probably not enough for a house. You decide to invest it in something, but with so many options out there, it can be overwhelming. You could invest in stocks, shares, equities, government or corporate bonds, real estate, crypto, NFTs, futures, watches, and more. You may have even seen those ads on YouTube from gurus talking about day trading and how you could make money through investing. On top of all of this confusion, there's the very real fear that you might lose all of the money you've worked so hard to save up. In light of all of that, here's the ultimate guide to investing for beginners. Part 1. The philosophy and basics of investing. The point of investing is for your money to make more money. Let's say you start off with $1,000 that you've saved up through hard work. You could put that money under your mattress or in a bank account, but the problem with that is that there's inflation. Your $1,000 might be able to buy a MacBook Air right now, but in a few years, when inflation goes up, that MacBook Air could cost $1,200. Over time, your money loses its purchasing power. That's why you want to invest in something, because when you invest, your money grows magically on its own, but more on that later. Investing can combat the effects of inflation. Now the question is, how does your money magically grow in the first place? The philosophy behind investing is that you buy something now, and that something makes you more money over time. There are two ways in which the thing you buy can make you more money. Let's say you buy a house. It costs a certain amount of money to buy a house right now, but there are two ways the house can make you money. First, you can rent the house out, so you're getting rental income every month. Second, the value of the house will hopefully rise over time. If you hadn't bought the house and had that money sitting in a bank account, you would be losing money because inflation would eat away at your savings. Houses are an interesting example because you get rental income, and it's easy to imagine what that looks like. But with most other asset classes, you don't have this equivalent of rental income. Instead, you buy something and hope you can sell it for a higher price over time. The main exception to this is some stocks and shares, which we'll talk about later in the video. There is a long list of asset classes that you may have heard of but may not be entirely familiar with. We've got stocks, shares, and equities, which are kind of the same thing. We've got hedge funds, index funds, government and corporate bonds, watches, fine arts, crypto, and more. All of this can get complicated quickly, so for the rest of this video, we'll simplify things and talk about investing in stocks and shares. That's the main kind of investing that normal people like you and me can unlock fairly easily. You don't need to have large amounts of money to invest in a house, take on huge amounts of risk and gamble like you need to do with crypto, or be an accredited investor like you need to invest in ancient investing companies or other complicated investments. Stocks and shares are the basics of investing. When people talk about investing their money, they usually refer to buying some Tesla, Netflix, or Amazon. We'll talk more about this later in the video, but for now, let's go over some basics. When you invest in stocks, you're buying a small portion of ownership in a company. When the company does well, the value of your portion goes up. When it doesn't do well, the value of your portion goes down. It's that simple. The idea behind investing in stocks is that you're betting on the success of the company, and that over time, as the company grows, so does the value of your portion. Now, investing in stocks does come with risks. You could lose your money if the company goes bankrupt or doesn't perform as well as expected. But historically, investing in stocks has been a reliable way to grow your money over the long term. According to data from the S&P 500, which tracks the performance of 500 large-cap companies in the United States, the average annual return on stocks from 1926 to 2020 was about 10%. So, investing in stocks is a good way to combat the effects of inflation and grow your money over the long term. But how do you actually get started with investing? We'll cover that in the next part of the guide. Part 2. Understanding stocks and shares. Now that we've covered the philosophy and basics of investing, let's dive deeper into stocks and shares. A stock represents ownership in a company, and a share is a unit of that ownership. When you buy a share of a company, you are essentially buying a small piece of that company. The value of that share will go up or down depending on the success of the company and the demand for its shares. The stock market is where stocks and shares are bought and sold. It's a platform where buyers and sellers can trade shares of public companies. The stock market is also referred to as the equity market or the share market. Some of the most well-known stock markets around the world are the New York Stock Exchange, NYSE, the Nasdaq stock market, and the Tokyo Stock Exchange. When investing in the stock market, there are two primary ways to approach it: active investing and passive investing. Active investing involves researching and picking individual stocks that you believe will perform well. Passive investing, on the other hand, involves investing in a diversified portfolio of stocks through a mutual fund or exchange-traded fund, ETF. While active investing can potentially yield higher returns, it requires a significant amount of research and knowledge to make informed decisions. Passive investing, on the other hand, is more hands-off and involves investing in a collection of stocks that mirror a particular index, such as the S&P 500. It's important to note that investing in the stock market comes with risks. The value of your investments can go up or down depending on various factors, such as market fluctuations, economic conditions, and company performance. However, historically, the stock market has provided higher returns over the long term compared to other types of investments, such as bonds or real estate. Part 3. Creating a plan and getting started. Before investing in the stock market, it's essential to create a plan and set goals. Ask yourself what you want to achieve through investing and what your time horizon is. Are you looking to invest for short-term gains or long-term growth? Once you have a clear understanding of your goals, it's time to start researching and educating yourself on different investment options. Start by reading books, articles, and blogs on investing. You can also attend seminars or webinars, join investment clubs, or talk to a financial advisor. When you're ready to start investing, it's crucial to open a brokerage account. A brokerage account is a platform that allows you to buy and sell stocks and other securities. Finally, it's important to remember that investing is a long-term game. Don't panic if you see your investments dip in value during market downturns. Stick to your plan and continue investing in a diversified portfolio of stocks over the long term. Over time, your investments have the potential to grow and compound, leading to long-term wealth accumulation. In conclusion, investing can be an excellent way to grow your wealth and combat the effects of inflation. However, it's essential to approach investing with a clear plan and understanding of the risks involved. By educating yourself and investing in a diversified portfolio of stocks, you can set yourself up for long-term success.